Howdy, y'all. Welcome back. It's the Liberty Call for Thursday, December 23rd, 2021. It is Christmas Eve. Hope everyone's having a great day out there in the interwebs. Again, another beautiful day here on the Front Range of Colorado, or in Colorado. So it's probably been in the 50s, maybe tickled the 60s down in a little bit lower elevations than where I'm at around 7,000 feet. So really beautiful today. So went into town, ran some errands, went to go try and pick up my mail at my office, and no one was there. So I guess, I don't know if the door was open, but there was no one in the lobby to help me. So anyways, well, I guess I'll have to put that off to a later date to go grab my mail. But I did get some errands done and swung by the grocery store on my way back out here to the sticks, and it was nuts. I mean, people everywhere. I mean, I thought in the middle of the day that usually going to King Soopers, which is our Kroger, there's usually no one there, but not today. I guess everybody's trying to get an early jump on their Christmas shopping. So, and there's an outlet mall across the street from the grocery store. So it kind of makes the traffic a bitch around there. So, but other than that, pretty good day. The market looked pretty good. It appears to have been up across the board here in the U.S. So, anyway, so if it's your first time watching, be sure to like, subscribe, and share with friends and family. I would greatly appreciate it. My little puppy's down there on the ground. You can't really see him. He's, if you hear any jingling, that's Jake, the Assistant Deputy Director of Security around here. So, all right, well, let's go ahead and jump in and see how the markets did today. Dow Jones was up 0.55. S&P 500 was up 0.6, NASDAQ up 0.85, small caps are up 1.02. The VIX was down 3.6%, taking it down to 17.96. If you remember, anything over 30 is usually really, really bad. And, as long as that number keeps dropping down for the short term, we should have some smooth sailing through the end of the year. So, all right, Europe looked pretty good. We see a lot of green across Europe. And same thing down here in Asia. So for December 23rd, things look pretty good across the markets. All right. So I have a couple articles, or 3 articles. A couple is 2, according to my older boy. When he was little, I always would say a couple all the time, just because that's, a couple is a handful. And he's like, a couple is 2. Yeah. Well, now he's like 31 years old. And he gets a good chuckle out of it. All right, so this first one is U.S. consumer spending buffeted by fastest inflation in decades. This was an article from Bloomberg, and I don't see who wrote it. All right, so let's go ahead and jump in. U.S. consumers took a breather in November, a month after a holiday spending surge, but that pause risks becoming more lasting if Americans pull back when faced with both the fastest inflation in decades and the Omicron variant. Purchases of goods and services after adjusting for higher prices were little changed following a solid 0.7 gain in October. The government figures were the marquee of the pre-holiday burst of economic reports Thursday that showed stronger orders for durable goods, increased new home sales, and firmer consumer sentiment. Underlying the spending figures are a series of cross-currents buffeted by headwinds about snarled supply chains. Many Americans started their holiday shopping earlier than usual this year, helping to explain the strong advance in the prior month. But consumers are also facing the fastest inflation in decades, with every trip to the grocery store and gas pump eating away a little more of their paychecks. People have less left over for discretionary purchases. And the new Omicron variant of COVID-19 threatens to curb the incipient rebound in outlays for services. The report showed Americans were spending more on essentials amid the pickup in prices. Money spent on housing and utilities increased last month, as did outlays on gasoline and food. The data showed inflation-adjusted spending on services rose 0.5%, the most in 3 months, while good outlays dropped 0.8%, the first decline since July. The personal consumption expenditures price gauge, which the Federal Reserve uses for its 2% inflation target, increased 0.6% from a month earlier and 5.7% from November 2020. The highest reading since 1982. The data the data come on the heels of the hawkish pivot by Fed officials who have been under pressure to take action against overheating prices. Last week, the central bank announced it would accelerate its bond. Yeah, we know that. Consumers are saving less amid the rapid price increases. Adjusted for inflation, disposable personal income and after-tax income fell 0.2%, fourth straight decline. The savings rate, personal savings as a share of disposable income declined to 6.9%, the lowest since December of 2017. What Bloomberg economists say, a flat reading on real consumer spending in November, even before Omicron hit, suggests inflation may be starting to weigh on consumer resilience into year-end. The increase in services was widespread, a positive sign of rotation out of goods spending going into next year. And that was Yelena Shalavateva and Anna Wong, economists. Though federal spending has waned, a host of companies have hiked pay this year to attract and retain talent amid widespread hiring struggles. In November, wages and salaries rose 0.5%, following a 0.8% gain in October, the report showed. The core price index, which excludes food and energy, rose 0.5% from the prior month and 4.7% from a year earlier, the fastest gain since 1983. Ian Shepherdson, chief economist at Pantheon Macroeconomics, said he's scaling back his forecast for the gain in the fourth quarter consumer spending on the grounds that Omicron COVID wave appears to be hitting spending at restaurants. The firm now sees outlays rising at 5.5 annualized rate in the period, down from the prior 6% forecast, according to a note on Thursday. Meanwhile, the outlook for both manufacturing and residential construction appears solid after a pair of Thursday reports showing stronger bookings for durable goods and the firmest pace of new home sales in 7 months. Orders for goods meant to last several years increased 2.5% from prior months, spurred by more bookings for commercial aircraft, motor vehicles, metals, and communications equipment. While the core capital goods orders softened, the figures follow steady increases in prior months that illustrate a robust pattern of business investment. Housing demand is also flexing some muscle and keeping builder backlogs elevated. Purchases of new single-family homes increased 12.4% to a 744,000 annualized pace, although the prior was revised down sharply. On homes sold last month, construction on 221,000 had yet to be started, the most since May, suggesting backlogs are growing. Separate data from the University of Michigan showed consumer sentiment picked up last month as households grew more upbeat about the economy and the outlook for their finances. And the Labor Department said new applications for state jobless benefits totaled 204,000 in the week, ending December 18th, unchanged from the prior period and underscoring a subdued level of job losses. So what we see here is, it's kind of a mixed bag. Some things look good, some things look weak. Obviously inflation is still, our biggest concern right now, and primarily that was caused just simply by all of the cash that was infused into the economy over the last 2 years. So in my personal opinion, it's going to take years for everything to get repriced, from stocks to fuel to, everything along the supply chain is going to take, I'd say, probably 3 or 4 years for everything to kind of, shake itself out and renormalize. Because you're going to have to factor in, wage changes, raw material costs are changing, fuel, energy to get, goods to and from wherever you're either selling them or manufacturing them. So, it's not just going to be, 6 months and everything's back to normal and, we've repriced it at, what goods are going to cost. So, like I said, it's going to take some time. Whether or not the Republic is still around to see the good things in the future, that's to be seen. So, all right, well, let's go ahead and jump to the next article I have here. 4 reasons to save for retirement now. And as a financial planner and investment advisor, there's never a bad time to start saving. So let's go ahead and jump into this. This was by Denise Appleby, I guess, yeah. And this was dated December 23rd. All right. There are dozens of excuses for not saving for retirement. Trust me, as a financial advisor, I have heard them all, and they all sound good. You may have a few of your own, but you should. Here are a few 4 good reasons to save for retirement. One, relying on Social Security. Social Security wasn't designed to be anyone's sole income in retirement. According to the Social Security Administration, its payments replace about 40% of the average wage earner's income after retiring. Most financial advisors say retirees will need about 70% of their work income to live comfortably in retirement. So there's a rule of thumb. Even with Social Security, you need to come up with about 60% of your income. You'll need 60% of the income you'll need to live comfortably after you retire. And then the other big problem is, will Social Security be here in 5 or 10 years? I've read more than my share of articles about how Social Security and Medicare are going to run out of money in this decade. So unless there's a solution to actually fix this problem, it's a tough spot for me as an advisor to be in for people who are, say my age, in their 40s and, maybe early 50s. Is this something that we can really rely on? For me personally, I'm not planning on it. If it's there, great. But I figure the money I poured into that over my lifetime is probably gone at this point. All right. Number 2, living with your children. Depending upon how much you like your kids, that may be good or bad. If you have children, you probably wouldn't mind spending as much time with them as possible, as you possibly can. However, you probably also want to be at your own discretion. Having to live with the kids because you can't afford to live independently isn't how most people want to spend their retirement years. Unless you win the lottery or get a big inheritance, you'll need to save enough to cover your expenses during retirement. Number 3, saving into a tax-deferred retirement account. The number of investment opportunities out there is infinite. But when it comes to retirement, your initial focus should be on the ones that were created with retirement savings in mind. And that is the tax-deferred retirement account. While saving is generally a good thing, the compound effect of savings in a tax-deferred account cannot be overstated. Why? It reduces the amount of tax you owe on the income for each year you invest in it. It allows you to defer or even avoid taxes you owe on the earnings that accrue on your investments. It produces earnings on earnings, creating a compounding effect not available in a regular savings account. If you work for a company, you may have access to a company-sponsored retirement account, such as a 401k plan. It could be your best bet, or could be your best. It could be your best possible deal for retirement savings if the company matches a portion of your contribution. The average company match in Q1 2021 was 4.6%, while some companies offer more and others offer nothing at all. If you are self-employed, run your own business, or your employer doesn't offer a plan, you can still contribute to a tax-deferred retirement account. You can open a traditional IRA or Roth IRA at any financial services company or a bank, or with someone like me. In either case, there are annual limits to what you can contribute. For IRAs, it's $6,000 and $1,000 catch-up if you're over 50. And for 401ks, for 2021, it was $19,500, increasing up to $20,500 for next year with a $6,500 catch-up for those over 50. How a retirement plan works, whether it's an IRA or a 401k, you can enjoy the immediate tax break of a traditional IRA or 401k, or the post-retirement tax break of a Roth IRA or Roth 401k plan. Here's an example. Adam earns $50,000 per year. His federal income tax rate is 22% based upon his tax bracket for 2021. He gets paid on a weekly basis. He contributes 10% of his salary to his 401k account each pay period. Adam's weekly contributions to his 401k will be $100. His paycheck will be reduced by only $78. If he invested nothing, Adam would make $962 a week and take home about $750. If he invests $100 a week into a tax-deferred account, he will take home about $672 a week. He takes home less than $78, but he has $100 more in his account. This is assuming his company contributes nothing to the account, but not all companies match a portion of the employee's savings. And as his salary grows, his contribution will grow. As his contributions grow, his balance will grow, and the benefit of compounding effects of tax-deferred savings. Tax savings over time. Say you contribute $15,000 to your 401k each year, which earns a rate of return of 8%. Assuming your tax rate is 24% and you invest these contributions for a 20-year period, the estimated net result compared with the effect of adding these amounts to your regular savings account instead of a 401k would be as follows. By adding the amounts to your tax-deferred account instead of to your regular savings account, you save $47,073 in taxes over 20 years. If you add up the savings to a regular savings account, the earnings that accrue on those amounts are taxed in the year those amounts are earned. This reduces the amount you're available to invest by the amount of the taxes you must pay on these amounts. And number 4, the compounding effect. Assuming you invest $50,000 and it accrues earnings at a rate of 8%, this produces earnings of $4,000. If your tax rate is 22%, that amounts to $880 that is paid to the tax authorities, leaving $53,120 to reinvest. Not only would you pay less in taxes, but the value of your investments would be greater as a result of the compounding effect of tax-deferred growth. About $630,000 if you saved the amount into a tax-deferred account, and about $580,000 if you saved into an after-tax account. So, all right, so that's about everything there. So, bless you, Jake. So, like I said, there's always advantages to saving, and using the tax loopholes as they are available is always a good thing. But unfortunately, I guess kind of rule of thumb, what I try to tell people is, try to start saving at about 25% of what you're making. Just set it aside. If it's too much, obviously you can move it down. But the earlier you start saving a quarter of what you make for the future, the easier you make it on yourself, the older you get. Because if you just get in that habit of not spending, every dollar you make, you're better off at that point into the future. All righty. And then the last one I have here is from Investors Business Daily. The title of the article is the 4% rule too high? Rule investors say it should be 4.7% rule. This was written by Paul Katziff, and it was published yesterday. As if you don't have enough to worry about, some retirement advisors are cautioning the famous 4% rule never works. Those doubting Thomases say if you withdraw 4% of your savings each year, then add a percentage equal to the inflation yearly. After the first year, your retirement savings will not last 30 years, that the 4% rule envisions. Those skeptics say the 4% rule will bankrupt your retirement balance well before 30 years. Your IRAs and 401k will end up as empty as the Mojave Desert way too early. You'll be broke in retirement. But is that true? One financial advisor who disagrees. Well, one retired financial advisor is William Bingen. He's the number cruncher who originally came up with the 4% rule back in 1994. Bingen says, if anything, the 4% rule is too conservative, not too aggressive. Retirees do not need to limit their annual starting withdrawals from retirement to 3 to 3.5%, as some financial advisors recommend, he says. Retirement savings, the 4% rule makes them last 30 years. Instead, retirees can safely withdraw up to 4.7% without threatening to wipe out their retirement savings before 30 years have elapsed, Bingen says. The reason so many people think the 4% rule is out of date is that they overlook its premise. He adds, when I did the original research, I was looking for the worst possible time to retire, Bingen told Investors Business Daily. That was late 1968, early 1969. Why was that the worst possible time to retire? At the time, a retiree would have had to endure 2 bear markets, 69 and 70, and 73 and 74, which caused his portfolio to shrink early in retirement, Bingen says. After that, the high inflation of the 1960s and 70s caused the retiree to increase their withdrawals at an unusually large amount each year to keep up with inflation. He said, those large withdrawals boosted the odds of early depletion of retirement savings. To avoid running out of money, Bingen calculates to a 4% cap on his first-year withdrawals. No longer the worst of times. But recent decades, especially since the start of the long bull market in 1982, have been a Goldilocks period in comparison. Bull markets have pumped up the value of retirement accounts. Low inflation has put a much smaller dent into the buying power of retirement savings balances. Many retiree investors taking 4% plus inflation adjustment withdrawals have seen their retirement savings grow, not shrink. It was really the high level of inflation of the 1970s that was really devastating, Bingen says. Bingen says retirees now can afford yearly withdrawals greater than 4% adjustments. With a proper asset mix, their account should still enjoy net growth. That's where his safe withdrawal level of 4.7% comes from. What Bingen does with his own money. How much does Bingen withdraw from his own retirement savings? Bingen, who is 74 years old, retired in 2013. At a time, I used a 4.5% annual withdrawal rate as my research dictated. He said that was from tax-advantaged accounts. He has reduced that to 3.5%, but the reduction is not because his accounts can't survive the 4.5% withdrawal rate. It's because his accounts have grown so much during the bull market that he doesn't need to withdraw 4.5%. My current withdrawal rate is 3.5% as markets have performed so well over the last 8 years, he said. The 4% rule is really 4.7% rule. There's another reason that the 4% rule, which Bingen says is really the 4.7% rule, still works. Bingen says some skeptics simply do not seem to read all of his research, including updates. Skepticism seems to ignore the fact that the 4% rule is based on a worst-case scenario. They make no allowance for the fact that we are far from the worst-case scenario or worst-case days. Interest rates remain historically low. Higher yield bonds and stocks entail higher risk. So both Bingen and skeptics advise resorting to a mix of yield plus selling securities to fund their respective withdrawals. I believe we all use the concept of total return, that is, yield plus capital gains, Bingen says. The difference in our withdrawal rate appears to be accounted for by the difference of our forecasts of future total returns. Some assume that very low rate of return for many years. Retirement savings. In addition, Bingen originally described how a retiree's portfolio was expected to behave based on just two asset classes, U.S. large cap and intermediate term U.S. government bonds. I've added 5 asset classes, Bingen said: U.S. small cap, U.S. micro caps, U.S. mid caps, international stocks, and U.S. treasury bills. In addition, the additional classes give a retiree's portfolio more flexibility. It tends to gain more value when markets rise and tends to lose less when markets fall. His original research assumed that stocks accounted for anywhere from 40 to 70% of the portfolio. His new allocation is 11% in each stock class, plus 40% in intermediate term treasuries, plus another 5% in 3-month treasury bills. Bingen examined outcomes of portfolios in the 30-year rolling periods. His current calculation is that 4.7 plus inflation is a safely sustainable annual withdrawal rate, applies to all retirees since 1968. So very interesting. I mean, me personally, I always try to err on the lower end of that threshold, just because, you know, I'd rather someone have a little more money when they're older than have less, and we're scrambling to figure out what we're going to do to make ends meet. So, all right. Well, that's everything that I had for today. I hope everyone has a wonderful Thursday evening. I'll be back tomorrow with the weekly wrap up. And if anyone needs anything from me this evening or into tomorrow, feel free to give me a call or shoot me an email. And I hope everyone has a wonderful evening. Have a great day. Bye-bye.